We're almost at the end. We've done all the assets, all the liabilities. So hopefully you know what we do in this lecture. We're at stockholders' equity. Here I'm going to do it a little bit differently. Instead of doing lots of journal entries, I'm going to talk a little bit more about the whys. We're going to work more on the big picture questions. What makes a corporation special is it's a separate legal entity, separate from the owners. That's different than if you're a partnership. It's treated like a person. With a partnership or proprietorship, the individual owners and the corporation are not separate. They're called flow-through entities because anything that happens to that partnership or sole proprietorship really flows through to this particular owners. It has an indefinite life, no end date. Corporations, by definition, go forever. A really important key is the number of owners and the transfer of ownership. You sell your shares to transfer the owners. And you can have shares that say you can only transfer to family members or things like that. You can have rules on who you can sell your shares to, but you don't have to. In a partnership, you have to rewrite your partnership agreements. In a sole proprietorship, you basically would sell the whole company and limited liability. And again, that goes back to that separate legal entity. But one really important thing is if you are sued, you're limited to the assets of the corporation. So that's really the really important part of corporation. If you're an entrepreneur, as soon as you get big enough to afford to become a corporation, and they have some cheap little ones. Remember, we talked about an LLC. That's a limited liability corporation. It's a cheap way to do that, but make sure you incorporate. Otherwise, if something that you or one of your employees does hurt somebody else, you can lose everything. Lack of mutual agency. And this one's kind of important. Separation of management and ownership. The owners hire the managers. Doesn't mean you can't be an owner and a manager, but it also means, though, that the owners can fire managers. And so kind of the most famous one that's sort of recently is Papa John's, public corporation, but Papa John was the CEO. He said some things that people didn't like. And so the owners, the shareholders of Papa John's, fired Papa John. They've since hired him back in a different capacity, and he's still an owner, but he was no longer allowed to be called CEO. They fired him as the CEO. So that's another reason you might want to keep 51%. Otherwise, your shareholders can fire you. Another big thing, and this makes a big difference on how you decide to incorporate, there are separate IRS rules for a corporation. You've heard about corporate tax rates. Corporate tax rates are different. One of the things that the prior administration did is they set corporate tax rates were as high as 35, 40%. They reduced it to 21%. And my guess is it will go up again. But one of the key things you want to know is, are you better off paying corporate tax rates or paying your personal tax rates? Capital accumulation just means you can generally raise more money, especially if you're a public company. And a public company means you're traded on a stock exchange. All stock companies are not publicly traded. For example, Enterprise, Rent-A-Car, they're a private company. They're a corporation, but only friends and family can't own those shares, and it's not sold on the New York Stock Exchange or the NASDAQ. Hertz, on the other hand, is a public company. You can buy shares of Hertz. even though that was started by the Hertz family. At some point, they do what's called an IPO, and an IPO stands for initial public offering. And you'll hear people talk about IPOs. That's the first time the company goes public. And that's the time when they issue stock, and any money they sell for those shares of stock actually goes to the company. After that, when you start selling stock, it's between owners. It's between the different people who happen to own the stock. But the initial public offering is where the company actually gets the proceeds from the sale. So, for example, I think one of the real popular recent ones, Uber, just went public. And then the other thing to remember, again, especially if you're traded, so especially if you're traded on a stock exchange, and that means you're a public company, then there's the Securities and Exchange Commission that regulates the stock market. If you decide to have stock, what makes it different is the stockholders get the right to vote. And as we said, one of the key things they vote on is they're going to choose who the management. They will usually vote to confirm who the auditors are going to be. And they can vote on other things as well. They can vote on, sometimes they'll say, we want you to be environmentally conscious of what you do. They can have things, we want you to vote on, animal testing if you're a cosmetic firm. Sometimes they want to vote on management pay. That was a popular one for a while. So there's other things that they can vote on. These are the only two that are always on the ballot. The other thing that happens with a corporation is they pay dividends. In this course, we don't talk about really what you call them if you're a proprietorship or a partnership. So we've always talked about dividends. But the key thing about dividends are they are never guaranteed. Even if a company has always paid a dividend, it still is not a liability until it's declared, because it's not guaranteed until the board of directors actually declares it. A third thing is for the stockholders, if the company goes out of business, the stockholders get the leftovers, meaning debt gets paid first. That's one reason why you might want to buy a bond. The bond gets paid first. If there's anything left over, then the shareholders will get something. The last thing is preemption. And this again is just a sometimes, depending on the shares of stock. This is true. What this means is if the company issues more stock, you keep your percentage. So you don't get diluted. Because obviously, if you have 10 shareholders, and you're one of them, so you're 1 out of 10, and then we issue another 100 shares, and now you're 1 out of 110 people, that's called dilution. Because we issued more stock, I still have my one little share, but now my share is not as much. So what preemption would say is, if I issue another 100 shares, my one share now becomes 10 shares in essence, probably a little more, so that you always keep your same percentage. If you've watched The Social Network, good movie about Facebook. It's a good movie. They keep it moving. But the problem with the little finance guy was he didn't pay attention to see if his stock had that preemptive clause in there. So when they went from having the 10 little people involved to selling it, having the IPO and selling it to millions of people, he didn't have his lawyer check to see if that clause was in it. So, and that's what they go through. Well, Zuckerberg had 20% before and 20% after, and all his other friends had whatever percentage before and after. and I can't remember the guy's name, but the one guy who kind of had a fight with everybody, his went from 10% to 0.0003%. But that's what preemptive is, and that's what's going on in that movie. Those are the rules about being a corporation.